Stock investing is an inherently rewarding enterprise. If an investor can manage his temperament and not get swayed by the greed and fear that the market evokes, investors can use sound rules both for stock selection as well as exiting the markets, and thus stop themselves from getting swayed by the bouts of greed and fear that grip the market. It should be emphasized that many great stock pickers have achieved below par returns because of their propensity to sell stocks indiscriminately in the market. Thus, selling stocks should be done with a great deal of caution, as a stock you may sell may go on to become a multi-bagger and you would miss out on the tremendous returns by selling too early. To avoid this type of situation, let us discuss the rules for booking profits by selling stocks at the right time. Now, when we talk of selling stocks, we can divide this topic into two: either selling a particular security or trimming the entire portfolio. We need to trim the entire portfolio when we don't have any particular reason to sell a stock but feel that the market is overvalued, or that we want to rebalance our portfolio as the equity market is not doing well. Here the investor needs to make sure that he sells only part of all the securities on a piecemeal basis and does not sell selected securities in an indiscriminate manner. He should also note that the market tends to trend for short and intermediate periods up to 2 to 3 years. Thus, a market which is trending upwards might continue to do so for some more time. This peculiar feature of the market means that rebalancing should ideally not be done more than once a year. Another requirement to trim a portfolio could be when there is a requirement for a goal which is coming up shortly. Here, it is suggested that the investor not wait for the goal date but start a staggered divestment of 25% of the portfolio every 6 months up to 3 years before his goal date. The markets are not conducive at any particular 6-month window. The investor will thus have the flexibility to withdraw at a more opportune time. Having covered the rules for selling or trimming the entire portfolio, we next turn to individual stock selling. Before we get into selling individual stocks, we will need to clear a few important points. The first point is that we are not talking to day-to-day traders, but long-term investors who are serious about building wealth. The second point is that when such investors select stocks, it is not to profit from daily or monthly moves, but from long-term compounding, which takes a minimum of 3 to 5 years. In fact, the holding period of any stock under value investing is 5 years. The third and most important point is that selling depends on the category of stocks. So broadly, there are two types of stocks an investor can pick. The first type is a reasonable business which is available at cheap prices. Examples of such businesses could be stocks like Coal India. Here the investing thesis is that it is a 100 rupee note available at 50 rupees. Naturally, once the 100 rupee note gets valued at 110 or 120 rupees, the investor would like to exit. Here, the investor can take a complete exit, but it should be noted that the threshold is 100% appreciation and not 20 or 30% as many traders are wont to do. Second type of stocks are long-term compounders. These are 100 rupee notes that are expected to generate 20 or 30% growth every year for decades, but these are available at the full 100 rupees. Here, the investor would generally have a longer holding period, as such compounding machines are not created every year but are few and far between. So the investor will have to be cautious when trimming such stocks. A simple rule to frame for these type of stocks is that the investor should only trim part of his portfolio by only partially booking some profits. Another aspect investors should consider when exiting stocks is the circle of competence. The principle of circle of competence states that investors should only buy those securities where they have a good understanding of the business. A good understanding means that they understand the industry dynamics, the quality of management, what are the value drivers in the industry, etc. These things cannot be learned in a day, but they develop as an investor studies the quarterly reports, reads the earning transcripts, etc. So investors who quickly get in and out of stocks do not get the time to develop a circle of competence and instead develop a trader mentality, which is not conducive to making long-term wealth. Happy investing.